Welcome to Pankinen Financial Perspective with Ashton Pankinen from Pankinen Financial Group. Planning for your financial future means navigating challenges like market volatility, inflation, and retirement income. Pankinen Financial Perspective is here to help by addressing common financial concerns, sharing valuable strategies, and exploring ways you can work toward your financial goals. Now let's get started with Pankinen Financial Perspective.
Hello and welcome to Pankinen Financial Perspective. My name is Ashton Pankinen from Pankinen Financial Group. If you'd like more information about what you hear during our show today, give us a call at 952-873-2703 or visit us online at pankinenfinancial.com. That's PANKONIN financial.com. And while at my website, click on the radio page to check out past shows and to subscribe to our program on Apple Podcasts, Spotify, or Amazon Music. While at my page, click the link at the top of the page to get the most recent retirement guide or sign up for our newsletter. Many people think that investing is only something you do during your career when your goal is to pile up enough assets to help you retire and enjoy your preferred lifestyle. But in truth, there's no reason you can't keep investing after you're fully kicked back and embrace the retirement lifestyle. After all, the more you grow your finances, the better off you're likely to be, even in retirement. But before we get into our timely topic, let me introduce my co-host, Tony Shore.
All right. Well, great to be here with you, Ashton. I am excited about today's show. It's going to be a good one. It is a very timely topic. And speaking of timely, can you believe it's already August? And, we're almost NFL pro football is going to be starting here soon.
Yeah, it's crazy. We always joke barbecue days is middle of July here and third weekend in July, something like that. And once we hit that, we say, all right, might as well start school. Summer's over. Time flies in August here.
It does.
It's crazy. We'll be starting school here right after Labor Day. So.
Yeah. Well, it's crazy. I mean, the first NFL football game, we're just a few short days away from preseason. It's hard to believe.
What do you think? 17-0 probably for the Vikings, or
I'm thinking, I'm going to give it 2 games. We'll lose a couple. So maybe 15-2.
Yeah, I like it.
Yeah. 15-2. That's my prediction. Go Vikes.
Yeah.
Can't wait.
Are you hosting the Super Bowl party or am I?
I thought it was going to be you. I'm pretty sure it went to, Wyndham. Wyndham or Worthington. I think it's going to be the Wyndham guy that hosts this year. Right?
Yeah, I like it.
What's the high school team's name in Wyndham?
The Eagles.
Yeah, the Eagles. And we were the Trojans. Yeah.
Worthington Trojans versus the Wyndham Eagles.
I remember playing you guys in football.
Yeah.
I was a nose tackle. Yeah.
I was too.
That's crazy.
Nose tackle and strong safety just depend on the set. So
same.
Yeah.
I was so bad though at offense and blocking that I was just not I get the plays confused, so I wouldn't block the right direction. So they just put me on defense only. I did pretty well on defense. I was one of the smallest nose tackles they ever had, actually. But
me too. Jeepers, crepes.
Yeah.
What's the odds, huh? Yeah, I think I graduated high school at $178 or something like that. Played nose tackle.
Yeah, same. Yeah. I mean, I've put on just a little bit of weight since then, Ken. The camera
you make a much better nose tackle now.
Yeah, I would, wouldn't I? High school. If I could play now at the high school level, I might be able to accomplish something. No, they'd run right over me. Yeah. Which they did sometimes back then. I remember, who was it? Pipestone or Laverne? A guy just ran. I usually would blast them. Sometimes I caused a fumble because the minute that ball moved, I hit them as hard as I could. If I saw the ball even flinch, boom. But I'll never forget getting just ran over by a huge center. I mean, he outweighed me by 100 pounds, I swear. And it was either Laverne or Pipestone. So
they both had some big boys they were breeding over there.
Oh, yeah, that was for sure. Well, I tell you what, Ashton, this is going to be a great show, a good topic. Retirees should keep investing. It's like a lot of people might be thinking, well, once I'm in retirement, my paycheck stop, how do I keep investing? Well, maybe stay invested. Sometimes you move your money around. Sometimes money comes in other ways. So, you always want to stay invested. And I think this is a good topic to discuss. How do you do that? I've always assumed, a lot of people, I think I used to assume, and I think a lot of people do, that once we're retired, you don't even need to think about or worry about investing. But that's not right, is it?
No, I mean, again, first retirees should view themselves as long-term investors. Again, retirement isn't a finish line. It's a brand new chapter. Again, it may be the end of your career, your working days. But again, we've got hopefully another 30 years in retirement.
Yeah, it's a new beginning. It's not an end. It's a beginning to to another third of your life. So
yeah, hopefully, again, with all that being healthy and active and those types of things. But a lot of people are living into their 90s. I think if a non-smoking couple has a 46% chance that one of them will live to age 95. And then there's nearly a 1 in 5 chance that you'll reach age 100. So a 20% chance that you'll reach age 100. So again, this isn't the end. It's maybe the end of your career, but it's the beginning of hopefully a long and healthy, vibrant retirement as well.
Well, yeah, and that's true. I would agree.
Yeah, and again, it's not just longevity; it's an opportunity. Where things get tricky is when paychecks stop and you start drawing from your savings each month. It's easy to slip into that short-term mindset because you are taking income from it, and so that's understandable. But monthly expenses don't take a vacation in retirement, so it can cause many retirees to see themselves as short-term investors, even though they're often only tapping into a small portion of their portfolio each year. And so again, we want to look at this as a long-term. It's a time horizon thing. It's not, hey, we've got 30 years to work until retirement and 30 years, and then we're going to be done investing. We have another 30 years to live in retirement as well.
Yep. There you go. Yeah, I think most people will end up spending a long time in retirement. People are spending longer and longer in retirement. So we need to be prepared. I think that's good. So what's the move here? What do we need to do?
Yeah. And so the real power is embracing the perspective that we are long-term investors. Mm-hmm. It gives our portfolio room to breathe. So to weather downturns and bounce back over time. You want to make sure you stay focused on the long game because you want them to keep your investments to keep pace with inflation. So your money works as hard as you did. You don't want to just stick it under your mattress and then have inflation eat away at it. And again, it's going to mark the end of your career, retirement is, but it's also the beginning of your legacy if you plan accordingly to that.
Yep. And, I think what better way to plan accordingly than by working with somebody like yourself, Ashton, a financial services professional who can sit down and come up with a written plan for you.
Yeah, for sure. And so again, part of that plan is going to be to make sure we have some stock exposure. Because if you're investing for the long haul, time is the greatest ally for you. And so if we take a look at the stock market over the past 30 years, it's been able to, since 1977, I guess, it's been able to deliver twice as high of a return as ultra conservative investments like treasury bills.
Sure.
And so on average, stocks get about that 9.8% annually on a rate of return, while treasury bills, again, are considered a relatively safe conservative investment, lag behind at just 3.34%. on average for that rate of return. So that's about 6.5% you're giving up by being ultra conservative.
Yeah, that's huge.
Yeah, it's not just a difference in the numbers, it's a different in outcomes, your retirement outcome there.
Right.
Tony. And so, and I understand, Tony, stocks comes with ups and downs.
Yep.
And during the past 50 years, their volatility is more than about 5 times greater than a treasury bill. But the key is if you're a long-term investor, you don't have to fear those ups and downs. You need to learn to ride with them. And again, it's not meant for your whole portfolio to be into that, those individual stocks or stock mutual funds.
Well, there you go. And again, you don't have to do it alone, right?
That's exactly right, Tony. A thoughtfully well-diversified portfolio that you build in close partnership with someone like myself can smooth out a lot of those ups and downs. We talk a lot about a 60-40 portfolio, 60% stocks, bonds, 60% stocks and about 40% bonds or conservative investments in there. You've also heard me talk a lot about the 60-20-20, where, maybe we have 60% in the stocks, 20% in bonds or bond-like alternatives, and then 20% maybe in a principal protected product like a fixed index annuity or a MYGA, multi-year guaranteed annuity, guaranteeing you a certain percentage every year to, again, protect that principal. And having that money outside of the bonds and the stocks gives you protections in years where stocks and bonds both lose, which we've had happen in 2022 and 1970 as well. And so, again, making sure you work with a professional to have that well-diversified portfolio that's going to give you some equity exposure because, again, hopefully we've got a long time horizon in retirement as well.
Yeah, there you go. And how does inflation factor into all this, though? I mean, obviously, we have to take market volatility is the price of admission, and you have strategies to deal with that. But what about inflation?
Yeah, and so inflation just doesn't knock at the door to come in. It quietly sneaks in and makes itself at home. For retirees, it's one of the sneakiest and most dangerous threats for long-time financial security. Over 30 years, even a modest inflation rate, that 3-4%, can dramatically reduce purchasing power. And so, again, what seems like that small increase year over year really adds up and fast. And then there's years where inflation maybe isn't so silent. It does come kicking through the door, like 2022, when prices jumped sharply in a matter of months. Or think back to retirees in the late 60s and 70s when relentless inflation, it was a tough time to get that fixed income to work for you because as interest rates rise, that fixed income price falls. And so it's important to have that diversification between stocks, bonds, maybe some principal protected products. And that can mean less turbulence without giving up all the journey's rewards there.
Sure. So inflation's always a biggie. You got to deal with volatility in the market, inflation. So then how do you invest your heart? You've saved all this money up. And a lot of people say, well, it is invested. I've saved all this money up in a 401k or IRA, but maybe some people have large sums elsewhere. How do you invest your hard-earned savings?
Yeah. And so you want to make sure you have money that grows faster than the prices rise. So again, that mix at 60-40 or 60-20-20, depending on what it is. And again, goals for individuals. You want to have some of that in that stable money, that 40% in that stable money that helps even out some of that volatility from the stock market. And delivering long-term growth can help preserve your lifestyle, not just your capital. So again, a lot of people want to protect that principal. Hey, I never want to drop back down below, the principal I have in the $1 million I had in my 401k. I never want to drop back down below there. But again, we want to be able to keep up with inflation because that $1 million 20 years from now isn't going to be worth what it is. It doesn't have the purchasing power of what it would today in the market there.
Yeah, you want to exceed inflation, not just you at least need to keep up. But you'd like to your interest rate, your money you're making to exceed the cost of inflation, which can be hard some years. Lately we've had some struggles with inflation a few years back. So a couple of years now. Any thoughts for our listeners out there? How can they get a hold of you if they want to put a plan in place to deal with these things, make sure they're properly invested?
Yeah, that's something we help out with all the time, Tony. Clients call us, hey, am I invested correctly? I'm 10 years from retirement, or I'm looking at retiring next year. Am I invested correctly? And the best way, you can visit my website. Listeners can visit the website at pankinonfinancial.com. That's PANKONIN financial.com. Call our office, 952-873-2727. 952-873-2703. Again, that's 952-873-2703. And we'd be happy to discuss how we can answer your questions, address concerns about investing during retirement, just take a look at your overall retirement goals and any other parts of your financial strategy. And again, it's our goal to help you prepare for the retirement you've worked so hard for. I always love to say, Tony, you've worked hard for your money. I want to make your money work hard for you as well.
Right. And that's great. You want your money to be working as hard for you as possible. And that's why you've been talking about this, Ashton, how for many retirees out there, the smart play is to keep investing rather than simply hunkering down with the assets they already have, the positions they already have. A terrific conversation. What's next?
Yeah. And so again, there's more information about your investment mix shouldn't stand still because your life doesn't. And so again, as you get closer to that retirement goal, we typically do become a little bit more conservative because now we're going to be looking at that distribution phase of retirement instead of the accumulation phase. And so a lot of times, again, as we get closer to retirement, we shift that. And not that we try and time the market, but if the market's up, it might be a good time to shift that. And the market's down, it might be a time to, hey, let's wait another year or two to make that slide into a little more conservative of a portfolio. And again, that it's all based on a customized approach because just because you're retiring doesn't mean you have to go to a conservative portfolio. I've got a lot of clients who can live comfortably off their Social Security, and maybe they have a pension at work, or we create a pension for them at with some of their investments through an annuity or something like that. And so again, it's just your mix shouldn't stand still because your life doesn't stand still. And so you want to make sure you adjust that appropriately as time goes.
Oh, for sure. Yeah. And so here's a big question. How much should you keep in stocks during retirement then?
Yeah. Again, every situation is a little different. If you take a look at the 4% withdrawal rule that we've looked at, that factors in having anywhere between 50 and 75% in stocks. Again, it depends on that goal. I've sit down with some clients who are 80 years old and still have 90% in stocks because they know this is never ever money, meaning, hey, they're not going to spend this. They want to leave it to their beneficiaries and they want to leave a legacy and they want that legacy to grow. And again, they know that between, could be a farmer who's got land rent and Social Security and maybe a pension, depending on what it is. And they know that they've got that monthly income. And so they're willing to be more aggressive in their portfolio. And so again, it depends on your own personal risk tolerance, the goals for the money, and your time horizon. And those are all factors that we look at when we sit down to see what truly are these goals and is there an opportunity to be more aggressive, or do we need to pull back the reins a little bit on there as well?
Yeah. Yeah, I think you make some great points there. Is there ever a point at which somebody should stop investing in the stock market?
Yeah, and so that's another good question, Tony. And so one of the things we look at is, hey, I'm getting enough income off my Social Security. I'm getting enough income off my pension. I really don't need my investments, so I don't have to take much risk. And that's a very thoughtful way to put it, because again, you can go into a bond portfolio a little heavier weighted into more conservative, and you're not going to see the fluctuations that you do in the stock market. And you're okay with that because you have that monthly income check. You don't have to take that risk inside of there because you have plenty of money coming in on a monthly basis. But then if you flip that around, Tony, that's actually an opportunity that, again, depending on goals and risk tolerance, that's actually an opportunity to take more risk inside of there. Because again, you're getting your monthly checks in to cover your basic needs and maybe even your entertainment needs as well in retirement or gifting strategies in retirement. And so you can afford to take more risk because that ups and downs doesn't matter, because again, whether the account's down 10% or up 10%, you're still getting your monthly income check inside of there. And so again, it's also customized, Tony. And part of my job is to evaluate that risk tolerance and then maybe even help move you along that scale if you are one of those that wants to stick it under your mattress and and have that silent threat, inflation, come and eat away at it. It's part of my job is to explain that and then come up with a customized plan to make sure that doesn't happen for you.
Yeah. I think that's obviously huge. You have to understand what's right for your personal situation. So how can working with somebody like yourself, Ashton, a financial services professional, help retirees with their investments then?
Yeah, again, it's making sure that we aren't taking that, there's a risk to being too conservative. And so again, making sure that's not going to be something that happens to us. Making sure we have that well-diversified portfolio. We use a lot of mutual funds here. And the reason for that being is it's inside of those mutual funds, you have hundreds of, or if not thousands of different investment options that well diversifies you. Sometimes we have it in international funds because sometimes that international does better than domestic and vice versa. And so we have some exposure to both their small cap, large cap, mid cap, value, versus growth stocks, dividend paying stocks too. If again, just to help reduce that volatility in the portfolio with those dividends continuing to reinvest and buy at a lower price. And then again, we also have some principal protection options as well for that conservative piece of the portfolio. Again, to help with the volatility of the overall portfolio when we mix those in, the principal protection keeps your principal protected in the down markets. A lot of times it's capped with not going to have as high gains, but again, it helps with leveling out that volatility of the overall portfolio.
Yeah. And that's what you want to do. Obviously, you have to deal with things like we've been discussing today. It's so important to understand the impact of things like inflation, market volatility, interest rates, and even taxes, right? I mean, all of these things affect investments or can affect your retirement savings. And again, when you enter retirement, some people think, well, I need to be really conservative or out of the market. But if you've got longevity in your family and you're healthy, you might still have 30 years. So, you don't get complete. You're not out of the growth market yet, right?
For sure. Yeah. And again, it's something we want to look at and say, hey, I know it's easy to say, hey, I have enough money coming in. Let's just be ultra conservative with this. Sure. But again, we still want to be able to take advantage of some of these growth opportunities in the stocks, equity portion of the portfolio. And again, it's that comfort level. Not everybody's created equal. So we'll sit down, create that customized portfolio with you. One of the things you mentioned, Tony, is taxes. And we talked about inflation, kind of the silent threat to your retirement.
It's the silent killer.
Yeah, the silent killer. And we have taxes as well that work into the play, because it's not just about what you make, it's about what you keep as well.
Yeah.
And so it's important. We have different strategies, tax strategies for retirees as well, to make sure we keep them below a certain income limit. If we don't want our Social Security taxed or something like that. So we've got strategies like that. We do have, maybe we pull from your Roth IRA instead of your traditional IRA. Maybe we've got some non-qualified money. And for that non-qualified money, we do have options where we tax loss harvest inside of there. And so we want to make sure we are doing what's best for each individual situation, having that customized plan it does no good to earn $10,000 in gains and then have to pay $2,500 back to Uncle Sam on those gains. And so it's more than just diversification. It's also tax strategy and keeping up with inflation as well. That silent killer. And again, the tax man maybe isn't as silent of a threat, but it's definitely
there's nothing silent about the tax man. The tax man cometh. Uncle Sam wants his share. We've talked about that before. Uncle Sam and Aunt Irma, the tax nightmare. They're the bad aunt and uncle that always want your money. So with taxes, though, the key is how much of those investments are taxable, because you're probably going to need them at some point in retirement, right? You need some of that money. So that's where tax-free buckets come in. And so it's one thing to still invest in retirement, but it's another thing to look at where your money is coming from, because as you said, I like how you put it, it's not how much you have necessarily, it's how much you keep and when you have it and when you need to use it. So timing and keeping what money you can keep and minimizing that tax burden is a big part of investment in retirement, isn't it?
It is, and we'll probably dive into this topic a little more on another show, but another thing we can look at is Roth conversions as well.
Sure.
If you're in your early retirement years and you don't need the income, and maybe we've got some room before we hit that next tax bracket, does it make sense to convert some of our traditional IRA money into a Roth IRA, pay the taxes now, passes tax-free to our beneficiaries. We don't know where those tax rates are going, 10 years from now. And, before we have to take them out at 73 or 75, depending on the year you're born, it may make sense to pay some tax on it now and convert it into a Roth IRA. That's going to grow tax-free for you and go tax-free to your beneficiaries when that time comes as well. And, I've got a lot of clients that, my kids are doing better than I am. And so those kids may be in a higher tax bracket than you as well. And so again, maybe it makes sense for you to pay the taxes and convert it to a Roth. And then when you pass, it goes to them a tax-free. And so it's not at that higher tax bracket of the child.
Yeah, it doesn't bump. They don't have to pay a higher tax rate, or it doesn't bump them into a higher tax bracket as well. And we'll do a whole show on Roth IRAs and tax-free options. But speaking of options, when we talk about investing in retirement, it's good to know you don't have to have it all in the stock market. There are so many different vehicles and tools that you can utilize now, and they've improved them so much. You mentioned one big one, the Roth. There's accounts that are attached to the market, like IRAs, Roth IRAs, and then there's insurance products and tools that you can utilize out there, like the MYGA that acts like a CD, but it's usually higher and pays out a higher interest, where you can stay ahead of inflation but not have risk all the market volatility. And so it's great to know there are just so many options now. Real estate has become an option for a lot of different people. Well, hey, we're out of time. It flew by. So Ashton, let us know one more time before we go how our listeners out there can get a hold of you to set up that no charge, no obligation consultation.
Yeah, the best way, Tony, is to reach me at my office, 952-873-2703. Again, that's 952-873-2703, or visit us on our website, pankoninfinancial.com. That's PANKONIN financial.com.
All right. Sounds great. Thanks, Ashton. Listeners, thanks for tuning in. That does it for today's episode of the Pankonin Financial Perspective.
Thank you for joining us for Pankonin Financial Perspective. Don't head into retirement without a plan for both your finances and your health. For more information, contact Ashton Pankonin at Pankonin Financial Group at 952-873-2703 or visit pankoninfinancialgroup.com. Join us again soon for another episode of Pankonin Financial Perspective. Advisory services are offered by Ashton Pankonin LLC DBA Pankonin Financial Group, an investment advisor in the state of Minnesota.
All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a licensed sales agent.